Welcome back, members. Now the session is on key amendments relevant to tax audit, and our speaker is for the session is CA Sumeet Khurana, sir. I request Treasurer of the branch, CA Kavita Pamesh, to escort the speaker to the dais and present a floral bouquet. It's my pleasure to introduce speaker, CA Sumeet Khurana, sir, qualified in the year 2001, since then practicing in income tax, focusing largely on litigation and appear before various appellate forums. Besides that, Sumit contributes his thoughts by writing articles and speaking on different forums. With this very short introduction, I request sir to take the session. Thank you.
So thank you, sir, for the kind introduction, and my thanks to the branch for having me here today. So generally, this is a statement that, post-lunch sessions are difficult. The difficulty for me today is not that it's a post-lunch session. The difficulty for me today is two champions have already raised a level, and I have to meet that level somehow. So with that note, we'll start. My scope today is pretty limited. Certain legislative changes which may have some bearing on the tax audit. It's not working. Yeah, thank you. Yeah, the first change we are talking about is the change in the definition of books of accounts. So we need to report in the tax audit report what are the books of accounts maintained and what are the books of accounts you have verified. And what is the change in the section regarding that is section 2 clause 12A, which defines books of account, has been modified. And the change therein is certain words have got added in that. How the section now reads is, the books of account include ledger, day books, cash book, account book and other books, whether kept in written form or in electronic form or digital form, or printout of the data stored in so and so medias. So the words which are added are, in addition to printouts, what was the earlier requirement, or manual, what was the earlier requirement, now it could be in the form of either electronic mode or digital mode. Now, all along we had been maintaining in these two modes. So then what led to this change? And what has been the background behind this? There was a search conducted in the case of GSNR Rice Industries. In this case, besides the regular books of accounts or the diaries, some loose papers, notebooks, etc., the CPU was also seized. The forensic team of the tax department discovered that there were certain entries passed in the software, accounting software, and were later deleted. So they retrieved not only the entries primarily, but also the deleted entries. From the deleted entries, they found something fishy. There are certain credits, debits, payments, etc., which have finally not found place in the final books of accounts. And on that basis, additions are made. Though the assessee largely explained those entries and the reasons of deletion, but the way the judgment has been written, it kind of can be used to say that the way the arguments have been taken and the way it has been written is that the entries in that CPU, that electronic form, do not constitute books of accounts. So that's probably the trigger which has led to this amendment, and for our responsibility towards the tax audit report now is to mention the form in which the books of accounts are maintained. And that's what the guidance note of the CA Institute also says, that not only the books but also please specify whether it is manual, whether it is electronic, or whether it is in digital format. the difference between electronic and digital is not too significant, but to summarily say whatever limited I have understood is, anything in soft mode primarily digital, but if something is stored and retrievable through a specific software and can be accessed from specified locations only, that is electronic. So that is fine distinction between electronic and digital. So now with this amendment, it is no longer necessary to have printouts, though earlier many of us were not maintaining printouts, but now it has become a little more flexible in terms of section having got amended. There is one more development which I would want to just briefly mention, though it is not specifically going to affect the tax audit we are going to sign now. It is the amendment I am going to talk about is not from the income tax law also, that's from the company's account rules, which is at the bottom of the slide. It is effective from 1st April 23 onwards. So what this is also seem to have some bearing from this judgment, because what it says is that every company which uses accounting software for maintaining books of accounts shall use only such software as has a feature of recording audit trail, edit log, audit trail, edit log, which can tell you when the entry was made, deleted, modified. So without this, the software should not be, you should not use the software which does not have this feature and should have a feature that it cannot be disabled. The audit trail cannot be disabled. So this requirement going forward from 1st April 23 onwards. Okay, with this limited note, I will move forward to the next thing. As in the preceding session also, section 14A has been dealt with, though it has quite died down as of today, but the limited change in that made is, we'll just deal with that. The clause 21H of the form 3CD, which talks about the amount which is indivisible because of section 14A. Now what is the change made in the section is, so far the section said that for the purpose of computing total income under chapter 4, any expenditure which is for the purpose of earning income not chargeable to tax or not included in the total income will be not allowed as reduction. Now the opening words of the section have been modified. Now the section says notwithstanding anything contained in any of the provision of the act. Now what led to this change probably is, there has been a judgment in the context of an insurance company. Insurance companies are governed by section 44. Section 44 of the Income Tax Act says, for computing taxable income of the insurance company, please don't look at the rest of the act. Please go to schedule 1. Schedule 1 tells you how does the computation mechanism for computing taxable profit of the insurance company. The section 44 used the phrase in the beginning, notwithstanding anything contained in the act. The computation will be governed by schedule 1. So the Delhi High Court took a position, blessed a position that in the context of insurance companies, because it overrides the rest of the act, it overrides section 14 also. Therefore 14A disallowance will not happen. Now, I'm just thinking, if I was to suggest a change how this should be addressed, probably I would have suggested that section 44, which says notwithstanding rest of the act, you add a phrase, but subject to section 14A. Now this is very interesting. The non-obstante clause has the ability to override. The subject to clause has the submissiveness. So there are two ways. If we have a conflict between two sections, the lawmakers can place the two sections in two ways. Number one, section 1 says notwithstanding subsection 2. Thereby section 1 overrides section 2. Otherwise saying is in section 2 you read subject to section 1. This is the position. So both these are quite alternatives. So they could have chosen the alternative of saying that section 44, which says notwithstanding rest of the act but subject to section 14A, life would have been easier, because you make it clear that while I am overriding rest of the act, I am not overriding section 14A. If that was the real intent, which probably maybe so, but the question now is, section 44 stands notwithstanding, you listen to me. 14A says, I don't care what is the rest of the act, you listen to me. So there are two now gigantic sections which say I am superior. Who is superior? Has this judgment, has this really been overruled? What is the situation when the two sections are in loggerheads with each other and both are having non-obstante clause? In the preceding session also, CA Deepak Chopra ji referred to some tribunal judgments in the context of 43B versus 44D something 44DA. Okay, then how the interplay happens. There have been certain Supreme Court judgments on how to resolve the conflict of this non-obstante clauses when two sections are not withstanding each other. One judgment Supreme Court says, please consider the purpose of two sections. Consider the policy behind that and based on that take a subjective call. Now that's a proposition the court has come up with, but subjective. The other Supreme Court judgment says that it is very difficult. I am not saying, they don't say that it is very difficult for us, but essentially the way they have proceeded is instead of getting into difficult proposition as to how to resolve conflict, the section which is later in time will prevail over the earlier one. That's a thumb rule, but not a very accurate. And the another judgment of Supreme Court says, don't go by which is later in time, which is earlier in time, go by which is specific, which is general. Now these things, which is specific, which is general, ocean in itself. They are judgments to define how to arrive at a conclusion, which is specific, which is general. That itself is a battle. So with all this, where do we stand? What is the conclusion we derive? It's a difficult proposition. I feel there is still a room to argue that section 14 has not been overridden, okay, based on the policy of the two sections as based on which is specific, because 44 definitely specific for the insurance companies. But given that if somebody refers to the legislative scheme, how it has happened, this is judgment which has come, probably it is to overrule that, all that will also play part in any court to arrive at a conclusion. But fortunately what remains untouched besides couple of other things is the MAT provisions. They are still immune from the rigid mechanism of 14A. Now we had earlier certain judgments to say that section 14A applies only when there is actually you have earned an exempt income. There has been a dispute that you have made certain investments, these investments are capable of earning exempt income, but in the particular year there is no exempt income actually earned, whether disallowance should operate or not. Then the certain judgments came to our rescue, and now there is an explanation added to this section to say that for removal of doubts. Now courts were consistently saying undoubtedly section 14A cannot operate. Assessees are also pretty clear the 14A cannot operate. Whose doubts they are going to remove, I don't know, but they say for removal of doubts, as their general habit is, anything which they want to introduce to modify the judgments and judgment law for removal of doubts, as if courts had a doubt. For removal of doubts, it is hereby clarified that notwithstanding anything contrary contained in the Act, the provision of this section shall apply and shall be deemed to have always applied. Our understanding as per the legislature has always been that disallowance should happen irrespective of there is actual exempt income earned or not. So they said whether at all you have there is accrual of exempt income, I don't care. The disallowance of an expenditure which is actually for the purpose of earning exempt income, that should take place. Now this kind of proposition was also canvassed by circular number 5 of 2014. CBDT circular 5 of 2014 also said the same thing, but the courts did not give much importance to the circular. They said no, it does not canvass the correct legal position. Now they have come back and blessed the circular by a legislative amendment. Now this common problem when the provision says that it is for the removal of doubts, whether it constitutes a retrospective amendment or it is a prospective amendment. That's a problem we face almost in every budget. And I'm sure you must have heard this discussion umpteen number of times, but let me reiterate once more. The law laid down in this context is principally forget what is the clause used. Even if it say for removal of doubts, it is hereby clarified, etc., etc. This phrase has got no legal sanctity. What a court should ideally see is, it should interpret the law as previously existing and see whether the new provision was actually envisaged by old law. whether the amendment now made is actually clarificatory of the existing law, or is it really going to, it is a mandatory in nature. And applying this kind of principle in the case of ERA infrastructure, Honorable Delhi High Court has already dealt with this explanation and said that this explanation is prospective in nature. So for your assessments and all, this is going to be very handy when the department is definitely going to rely upon the language used of clarificatory, etc., for the removal of doubts. This ERA infrastructure Delhi High Court is going to come to your rescue. Now there is another clause which talks about reporting of income under section 56 to 10. Another beloved provision. Now, the amendment made in this section is by introduction of two clauses pertaining to COVID related transactions. Section 56 to 10 says that what is all taxable under this. Then there is a proviso at the bottom which says provided that following receipts will not fall under this clause. In that proviso, the two further sub clauses added, clause 12 and clause 13. Now this clause 12 says that provided that this clause, that is 56 to 10, shall not apply to any sum of money or any property which is received by an individual from any person in respect of expenditure actually incurred by him on his medical treatment or treatment of any member of his family for any illness relating to COVID. Now before we move on, we just take a look at what this really says. I just noticed a peculiar difference here. It says for his medical treatment or treatment of family members. Now for his on, the word is medical treatment. For family members, the word is only treatment. What kind of treatment? Spa treatment. I was just thinking that why this word medical is not repeated when it comes to family members. Are they at a superior position? It took me a while. I don't know why they do all these inventive things and make us struggle to understand the meaning of simple things. But I will later soon realize it is followed by the sentence which says for any illness relating to COVID. So treatment for illness relating to COVID will be medical treatment only, whether you use the word medical or not. It's not going to make much difference. Now actually incurred. What is the meaning of this phrase actually incurred? If I contracted COVID, I actually incurred some expenditure on my treatment and I got an insurance claim. And I also got a very beloved relative who has given me some money for that. Now, whether the expenditure actually incurred by me is net of the insurance I have got or it's total expenditure. Whether the answer will be the same if it is cashless insurance. That is where I want your views also. Because I don't have a perfect answer. It is my view, your view, finally some court's view. Okay. So therefore, I would like to have your views on this. If it is cashless, definitely it is not going to be incurred by me. Okay. But if it's not cashless, I have got later the insurance receipts. Can I say it is incurred by me? Later on somebody compensates it, a different matter. Is it possible to say that? We are driven by what? See, the thing is, how should we really go about looking at a provision? We generally see first logic. No, this is not appealing to me. Isn't it? Officers also say, no, sir, how can you do this? What sense is there in this? So the principle in taxing statutes fundamentally is there is no equity between tax. There is no equity in tax. Don't apply common sense logics. You see what the language of the law is and be with that. For example, in Supreme Court in the case of Kasturi and Sons, section 41 clause 2 was under dispute. The company received some insurance proceeds in form of kind. So the asset got destroyed and the section said that, what you have to reduce from the block is the money received. He said, I have not received money, I have received kind. They said, whatever you receive in kind or you receive cash or check, it is money's worth. The court said, no, word used is money. You receive in kind, it is not money, it will not be taxed. So you have to leave your emotions out, logic out for a moment. I'm not saying that you have to be illogical. It is different to say, it is a different thing to say you be illogical. It is another thing to say when the section is one, then you twist the section by logic. So I just leave it there. The point to bring is that, when we are interpreting the sections, we have to balance out a couple of things. Our emotions, the literal interpretation, and the other principles of interpretation which are applicable to the fact that dictionary meanings, the legislative history, the circulars, the memorandum, all have a role to play, but balance it out. Another element to be discussed in this is, it says not only the COVID infection itself, but for treating any illness relating to COVID. Now, what is this illness relating to COVID? There has been some kind of statistical study and this analysis that COVID has not only caused that temporary infection and some problem, but has also resulted into issues like blood pressure, heart, kidney. They have impacted the other organs also. So if those kind of illnesses are also there, this clause will cover the proceeds related to that also. Now then there is a requirement that you should have some kind of documentary evidence to ensure that your claim is valid. This notification number 91 of 2022 lists down the records, like you have to maintain the COVID positive report or the medical of diagnostic treatment regarding record, and the illness should be suffered within 6 months of having contacted COVID. So that's the condition given by the notification. There is no maximum limit of this amount which is for treatment of illness, and anybody can be a payer. The section doesn't talk about who is the payer, who's any relation, etc. with that. And there is a requirement to file a form 1 mentioning that how much I have received, what is that I have spent, and the person, the PAN number, etc. The other clause, the clause we have just now dealt with is clause 12, which talks about expenditure in relation to medical treatment for illness. Another clause, clause 13, has been introduced, which deals with payment in relation to death. So if a person has died out of COVID or illness related to COVID, the clause says that exemption will be for any money or property received by a member of his family of the deceased person from employer. So any quantum of money received from employer will be not taxable under 56(2)(10) or from any other person. Now this clause is very interesting. If any other person it is received, then the quantum should not exceed 10 lakhs. But the phrase used here is from any other person to the extent such sum or aggregate of such sum does not exceed 10 lakhs. The clause originally talks about even the property, money or property, but the condition of 10 lakhs is attached only to sum. So sum represents sum of money and sum does not represent property. That's one proposition which can emerge out of this. The cause of death should be relating to illness and the amount should be received within 12 months from the death of the person, subject to other conditions as the central government may notify, which they have notified by notification number 92. Says death should happen if death has happened within 6 months of contacting COVID or founding the critical illness relating to COVID, then this clause is applicable. And there should be medical certificate certifying that illness had relation to COVID and other reporting requirements like filing some form, etc. So there is, as I said, there is no limit if the amount is received from employer. And there is one more clause, not these two clauses which have been recently introduced. There is yet another clause, clause 1 in the proviso, which exempts any amount received from any relative. The clause was there always. So whether it relates to COVID or out of pure love and affection, that is in any case out of the tax net. And this clause is only for when there is neither an employer nor a relative from any other third person, then sum of money is 10 lakhs and the property value, there is no clarity though, but my reading is that property value is not covered by 10 lakhs quantum, it is going to be unlimited. And for this proposition, there is actually judgment of Supreme Court in the case of H.H. Sri Rama Verma, which had interpreted the word sum. This sum means sum of money, and it does not include transactions in kind. Another connected point is that section 269 ST, which says that you should not receive any payments in cash. That is also important to bear in mind. If the transaction should not be in cash, if it is in cash, the the limit per day is 2 lakh rupees. So that's the only catch, because otherwise whatever is received in contravention of ST is the penalty itself in section 271 DA. Just for the sake of completeness, it says that the sum received by the family members. So family has been specifically defined for this purpose in section 10 clause 5 subclause 1 explanation 1, where it includes the spouse of the individual and parents and brothers sisters of the individual who are wholly or mainly dependent on him. It's a narrow definition. As long as the payer can be relative, so relative definition is pretty wider, which is in the section 56(2) clause 7. Now this is a retrospective amendment from 1st April 2020. So if unfortunately anybody has already offered that income tax, because when it was being done and received, that time there was no clarity. This amendment came much later. So there could be a possibility of filing either a rectification application or approaching the commissioner under section 264. Even if it is belated application, we have a judgment to rely upon in the case of Danny Denzogpa. In that case also, there was a retrospective amendment conferring an exemption, and Mr. Danny approached the commissioner under section 264 seeking a extension of time for filing review petition, which was ultimately upheld by court. Another interesting and important amendment is in the context of section 37. Now section 37, as originally understood, any expenditure for the purpose of business, not capital in nature, not personal in nature. The issues arose that whether hafta wasuli payment kind of things we should get deduction or not. Certain courts granted that deduction. Then somewhere in 1998, the section was there was an explanation added to the section that any expenditure for any purpose which is either an offence or prohibited by law, that should not be allowed as a deduction. Now, what an irony that now there is an explanation defining what is prohibited by law, what is an offence, etc. So, what is the scope of that phrase? Phrase is expenditure for the purpose which is either offence or prohibited by law. What does this mean? Now, there is an explanation to define that. And what it says is that for the removal of doubts, it is hereby clarified that the expression expenditure incurred by assessee for purpose which is an offence or which is prohibited by law shall be deemed to have always included ABC, three things. What are these three things? Firstly, it says that for the purpose which is an offence or which is prohibited by law for the time being enforced either in India or outside India. So the incremental thing is whether the default, whether the prohibition is by an Indian law or a foreign law. Both are impermissible. Any expenditure in relation to that is not deductible. Now, what led to this kind of change? Essentially, when you talk about the word law, it means law of the land. So when this section said anything prohibited by law or offence under law, it really meant law of the land, that is Indian law. And that is what was argued in the case of Milan Laboratories, that in that case some European Union body levied some fine. Whether that is deductible or not, the argument was that is not law of India, that's European law. Why should I suffer disallowance here for that? So that the tribunal accepted, but later on now this legislatively overruled to say that no, even if it is a law outside India, that is also impermissible deduction. Just to recap that what remains still unchallenged is if there is an expenditure incurred in defending any proceedings. So there is allegation of an offence and you are defending yourself in the court of law, that expenditure incurred for defending itself is not disallowed, not to be disallowed. Ultimate fine or penalty levied is only to be disallowed. And we also need to make a distinction between whether the fine or penalty or whatever is compensatory in nature or it is really penal in character. It has already been dealt in the preceding session to some extent. The second clause inserted is the real industry affected by this is the pharma industry. What used to happen was the pharma companies would give some freebies or gifts or incentives to doctors and other medical practitioners and diagnostic labs, etc. So those were under the scanner. There was a regulation by Indian Medical Council which said that the medical practitioners, they should not receive any gift, any travel facility, any hospitality or any cash or the monetary grant from any pharmaceutical or related industry. That was a prohibition on the part of the medical practitioners to not to receive that. Now the companies were paying these incentives to, and there was this news item also that for promoting Dolo 650 some 1,000 crores were spent. So any new drug you want to, the pharmaceutical company wants to promote, it spends huge money on these kind of things. So whether this is an allowable expenditure in the hands of the payer company. There were, after this Indian Medical Council prohibition, there was a CBDT circular number 5 of 2012 which took notice of this regulation and said that this expenditure will no longer be allowed as a deduction. Now this circular was challenged, the validity of the circular was challenged in a court and the court upheld that circular is valid. Despite that there were several judgments of different courts and tribunals saying that no, this deduction is still allowable because in the hand of the payer there is no offense. It may be prohibited in the hands of the recipient, that is not relevant. In the hands of the payer there is no offense, it is not, payment itself is not prohibited, receipt is prohibited. See, anybody can laugh at it, but see how the courts are functioning today. Today, very strange situation. So, they allowed this deduction at that flimsy ground, I would say. And now the clause which is inserted is that say if you provide any benefit or perquisite in whatever form to a person, whether or not carrying business or profession, if the payment is such that acceptance of such benefit or perquisite is violation of the rule or regulation governing that recipient, then that is not allowable deduction. Now what has happened is on 1st February they proposed this in the bill. On 22nd February, Honorable Supreme Court, because this issue was already in the courts, 22nd February the court has come up with the same answer, no, this is not an allowable expenditure, it is against the public policy itself. What is prohibited by the recipient is against the public policy to give. If it is against the public policy, you are not supposed to be allowing, getting that deduction. Now they have introduced that explanation. So in any case for past period Supreme Court is there, going forward that explanation is there, doors are shut now. So, again, what still remains, there is still something, as a tax professional, we still look to as something still left for us. So, there are a couple of different, categories of expenses which these companies incur for promoting the products. Certain things are like, they may give mobile phones, laptops, or AC, fridge, whatever they want to give. But there are certain smaller items, okay, for example, diaries, pens, calendars, wallpapers, etc., which are promotional in nature. So it is not for a recipient if the product is carrying a logo of that pharmaceutical company, you don't really receive it as a gift. You don't use it in public places. So it will be used only in your clinic or hospital to exhibit, and just it is more for the promotion of the company. So those kind of things are not necessarily falling within the definition of gift and all. So those promotional expenses would still be probably allowable for eligible for deduction. The third clause inserted, and this is very important. If there is an allegation of having committed an offense, and instead of the client struggling through the entire litigation proceedings to establish its innocence, it says I go for compounding. I pay a fee, I finish off the proceedings at the threshold itself. If the compounding fees is paid, is that an eligible deduction or not? Some courts said yes, some courts said no. Now the clause has been inserted to say that even if the payment is to compound an offense for any law either in India or outside India, that is also impermissible. The question is, number one, whether this is prospective or retrospective. Since there was no clarity of law earlier, there were conflicting positions, it is possible to say it is now prospective, and especially the memorandum also says it with effect from 1st April 2022. The another thing is, in the tax audit report, it is fine or penalty. Now, compounding fee does not fit into the description which is used in the tax audit report. Should you really report it or not? In my humble view, there is no specific clause in the tax audit report, but maybe we can have some other expert opinion on that, whether it really needs to be reported or not. It is certainly to be disallowed, but whether it is your obligation, if it comes to your notice, better to mention that to stay away from any controversy. Now, this item I want to talk about too is not a legislative change, but what has happened is Section 37 prohibits disallowance, allowability of expenditures. Okay. So, if there is infraction of law, if there is a penal action or something which constitutes an offense, expenditure for that purpose is definitely not to be allowed. But what if there is a loss? What will happen in a loss situation? For example, in a particular case, there was confiscation of goods by the enforcement agency. So, since the goods have been confiscated, that's a loss. It's not an expenditure in true sense. Whether that will also be governed by rigors of the explanation in Section 37, that's the question. Now, traditionally, there has been always maintained a distinction between loss and expenditure. What happened in a recent judgment is, in the case of Prakash Chand Lunia, the court said there is loss and expenditure, same thing. They say that whatever is impermissible, whatever is not to be allowed, whether it is in the form of expenditure or loss, the Section 37 will apply with equal force. In this case, the person was in the jewelry business, and his large portion of the transactions were very legitimate. Say 90% of the transactions are legitimate. He did some smuggling of some silver bars, some portion of the business smuggling portion, and that this got confiscated, and the question was whether that should be allowed or not. The court said, no, this is infraction of law, this has to be disallowed. We don't appreciate the distinction between loss and expenditure. And in this case, there were certain earlier precedents cited. In the case of Pyara Singh and Dr. T.A. Qureshi, these two cases, Dr. T.A. Qureshi and Pyara Singh, they were in the case of the SSC was in the business of smuggling itself. The whole business was illegal. What the court said is, indeed it's a wrong thing which the SSC is doing, but if you disallow entire expenditure, to say that no, everything is illegal, it is infraction of law, etc., what will remain? He will be ultimately taxed on the gross receipts. The income tax will become sales tax, which is totally against the policy itself. So they allowed the deduction. Okay. Now in this case, court said no, we don't follow that approach. First, in your case, we decide it is infraction of law, it is not to be allowed. Then they said those judgments are wrong. You are a legitimate assessee largely. For you, 99% legitimate, 1% illegitimate. When you are not allowing in your case, where is the question of they should have been allowed? So those judgments are bad in law. Rather than being guided by the precedents, they said we'll guide the precedents. Now, this Prakash Chand Lunia is a division bench judgment. It is rendered by two judges sitting together. There is a higher forum, 3-judge bench of Supreme Court in the case of Walford shares and stockbrokers, in which case 3-judge bench clearly brought out distinction between loss and expenditure. They are not the same things. So the question now is whether this Prakash Chand Lunia is correct, or since they have been rendered this judgment without the enlightenment of, without referring to the Walford shares and stockbrokers, whether it is par increment is wrong in itself. But be that it may, it's a difficult proposition today to claim any of these kind of expenses. The law has also got amended. Expenditure versus loss, that controversy will continue for some more time. Now moving on to section 43B, we'll just take a brief look as how, before we look at what the amendment has been made, how the judiciary has been looking at it so far, especially in the context of the amendment. There were certain clauses in this section 43B that if you are paying interest to certain specified financial institutions, interest will not be allowed as a deduction unless the interest has been actually paid. Now question arose, what if the interest payable has been converted into loan in a one-time settlement kind of a scheme, instead of, because you are not in a position to pay the interest, it's been outstanding for a long time, you reshuffle the things and you convert into a fresh loan. Then some of the courts allowed the deduction, and then the further explanation got introduced in the section to say, if you are converting interest into loan or borrowing, it will not be treated as having been actually paid, so disallowance will continue to operate. Now what happened in one particular case is, the assessee had outstanding interest, it issued debentures to repay the interest. So interest already payable, I am not in a fiscal position to pay interest, I issue debentures as repayment of interest. Now the question was whether the issuance of debenture is equivalent to converting interest into another loan. Now debenture undoubtedly is a loan only, but still that's the confidence with which some counsel approach the court. No, my lord, it is not conversion into loan. And he was able to convince the court also. In the case of Aqua, the court was moved by the argument that instead of paying interest, you have converted into debenture, that tantamounts to payment. Why they said so? Because they said that the debenture is a easily saleable security, and therefore it tantamounts to as if you have discharged the liability. Now with a view to overcome that judgment, what the explanation has been amended is to say is that even if it is converted into debenture or any other instrument by which the liability to pay is deferred to a future date, it is not to be treated as actual payment. So as introduced by the Finance Act 2022, conversion of interest into debenture or any other security by which the payment is deferred to a future date, that is also not to be treated as actually allowed. Now this disallowance will not operate permanently, because there is a circular which says that as and when you ultimately repay the debenture or whatever, redeem the debenture or repay the loan, that time you will get the deduction. Now what if instead of giving debenture, I issue equity shares? I have converted loan into equity shares, whether it will fall into the definition of any other instrument by which liability is deferred to a future date. The court in that context said that no, it is not a debt. Equity is not equivalent to debt. So any other thing will also be something which is similar to a debt only, therefore does not tantamount to conversion into a loan or borrowing or debt. So this case would still hold good in going forward cases. Similarly, if you take a fresh loan, so this is just a restructuring of the things. Instead of converting into loan, you take a fresh loan and repay this. That tantamounts to payment and you are eligible to deduction. I am just skipping some of the things which may not be so interesting. A section, now we have to report in your tax audit about TDS compliance. Now one of the major issues which have been brought in by the Finance Act 2022 is section 194R. I am sure a lot of debate you must have already listened to about the 194R, but just let's recapitulate that, because there are quite a lot of important things into this. Now this section 194R, before we get into nuances of that, there are certain peculiar things in that. There is one subsection 2 and subsection 3 which say that, this is an acknowledgement by the lawmaker that we know we are capable of creating difficulties for you, and the section we have introduced, we confess it must create difficulties for you, and therefore for the removal of difficulties we are empowering the board and to issue guidance, and this guidance will be binding on the income tax authority and the person who is paying the benefit or perquisite. So section 184R, as you would know, is governing the TDS on any benefit or perquisite which you give to any other person, especially being a resident. So they say that this guidance will be binding on the person paying the benefit and the income tax authority. The question somebody can ask is whether it will also be binding on the appellate authorities. Now the thing is, when the payer and as well as the income tax authority are bound by it, there is none of these can really carry forward the issue to any of the courts. They are bound by it. So therefore, the issue cannot be taken to the forums, at least for these two parties. But conspicuously, there is absence of any binding on the recipient. So as far as the recipient is concerned, he is not bound by any of these guidelines. Now, before we get into nuances, as I said, what is the scope of this binding nature? Because what has happened is the guidance issued by them, by the board, is at contrast with how the section we are otherwise able to understand. So our own interpretation of the section one way, if the guidance is on the other way, it still says it is binding. So what is the degree of binding nature? Now in that context, if we look at generally delegated legislation or the subordinate legislation cannot say something contrary to the act. That's a settled proposition. But in this case, because it said is binding, whether it will be an exception to the normal rule. We take a look at a particular section, for example, of Banking Regulation Act, which has a similar clause that there will be a guidance issued for removal of difficulties. In that clause, they specifically say it should not mean contravention of the act. It should not, nothing should be contrary to the act. So the guidance, to the extent it is not contrary to the act, it is binding. But in our case, that section, subsection 2 and 3, they do not use this kind of a phrase unless there is nothing contrary to the act. So in our kind of a case where it is openly worded, can it be said that even a guidance which is contrary to the section will be binding? Now for that, if you look at, there is a judgment of Supreme Court of Mahadev Upendra Sinai, wherein they have said that even in an open-ended clause, you cannot have a guidance which runs contrary to the very scheme of the act. So in nutshell, even if they say it is binding, it's binding to a very limited extent that so far it is in conformity with the act. And there are important points which we will deal with in a short while of time, where we will use this principle. Now the section only applies when the benefit or perquisite has been given to resident. If a perquisite is given to an employee, section 192 applies, and if it is given to a non-resident, then section 195 applies. Now we get into the genesis. Why this section 194 has been brought into existence? After all, what was the problem? What was going wrong which they wanted to address? It is stated that people are not reporting their income under section 28.4. What is 28.4? 28.4 is income, business income, which says any benefit or perquisite arising from exercise of business or carrying of profession. So if you receive any benefit or perquisite by exercising profession or carrying on business, that is taxable as perquisite under section 28. Where does this flow from? It flows from, number one, the memorandum of the Finance Bill 2022, which introduced Finance Act, which introduced this 194 section, and it is also repeated in the CBDT circular, which explains the Finance Act. So we are very clear, if we take a look at this, we are very clear that 194R is just a mirror image of 28.4. It is only to enforce, the purpose of 194R is to enforce the compliance with section 28 clause 4. Now there is a CBDT circular which has been issued, which is the guidance, the so-called binding guidance. What it says is, you please, as a payer of benefit, please don't see whether the payment is taxable under section 28.4. Now this runs contrary to the very purpose of the section. Now that is why I say, since this guidance is contrary to the scheme of the section, it should not be binding, because it says that you disregard its taxability. It also says that taxability is a kind of requirement in section 195. It is not a requirement in section 194R. So whether the recipient is liable to pay tax on this benefit or perquisite or not, the TDS provision should apply, which is again a clear contravention of the scheme of the act as in prevailing today. Now, in my view, 194R is clear offshoot of clause 4 of 28, section 28, and should apply only when 28(4) primarily conditions are met. So therefore, whenever there is a dispute, we should look at the legislative background from 28(4), what is the court rulings, what is the interpretation canvassed for section 28(4). And it has been held in the context of some different proposition, but Honorable Punjab Haryana High Court has held that the withholding liability, tax TDS withholding liability is a vicarious liability, and when there is no primary liability, when the recipient is not liable to tax at all on that particular point, then there cannot be any vicarious liability of TDS. And again, section 4(2). So TDS provisions are basically governed by section the chapter 12B, but section 4(2) says whatever is taxable under section 4(1) is only to be governed by TDS provisions. So the ultimate TDS provision therefore linked to your chargeability. Now what is this benefit and perquisite? This benefit or perquisite which we are talking about in section 194R is, typically if you take a look back, when conceptually the income could be cash in kind, we are all clear. There need not be any income, I mean there is no necessity that income should be cash and monetary terms only, income could be in kind also. So whatever was the pre-agreed consideration, at any point of time there was no difficulty that it's taxable as income. What happened is question arose in the context of voluntary payments. If this was a case of Acharya who used to give spiritual preachings. So one of his delegates, he gave him some gifts. So the question arose whether this voluntary payment is taxable or not. The court said that whether it is voluntary or not, it is paid out of exercise of his profession, it is taxable. Only if it is for purely personal nature, because of the personality traits of the recipient, it will not be taxable. So we know the broad context of this 194R is because various companies provide various kind of incentives and gifts to their dealers, distributors. Maybe this is a foreign trip given, or they stay in the hotel, so or some other incentives given. So those taxability of those is largely the issue, but to understand the applicability, we are just discussing in detail the nuances of that. So the question again arose, if the benefit or perquisite given is not convertible into money. In 1963, there was a case in the Gujarat High Court, wherein certain, this Acharya was given his expenses on his stay, his residence, his food, etc. was met by a body. Question was whether that is taxable in his hands. The court said no, this is not convertible into money, therefore not taxable in his hands. So that is where the legislature came into action to introduce section 28 clause 4 to say that benefit or perquisite, whether or not convertible into money, should be taxable. But the fundamental principle remained this that it should be it is a voluntary payment. It is not a pre-agreed consideration, only then 28(4) applies. Now another proposition is that benefit or perquisite should be arising from exercise of business or profession. The compliance requirement is 10% of TDS. Now its section says before providing the benefit I have to comply with TDS requirement. There is a proviso. So the body of this section talks about deduction of tax at the rate of 10% before providing the benefit. The proviso says if the benefit provided is either in kind or partly in cash or kind, then what I have to do is I have to pay tax. It says ensure that the tax required to be deducted has been paid before releasing the benefit or perquisite. Now if you see in the body of the section, it says it should be provided at the time of providing. In the proviso it says at the time of releasing. I am not too sure whether there is any real distinction between the two, but the point is in the proviso it says you should pay tax. Largely the payment of tax is governed by your 7th of next week, but here in this proviso says you should even pay tax at the time of releasing itself. So it's preponing your payment requirement. Now, if you're giving payment in kind, if you're leasing benefit in kind, how would you comply with this? So any thoughts on how would you comply with this? So you giving a benefit of purchased in kind, and section requires you to comply with payment of tax on that. How would you do that? Gross up. So one way is either recover from the person, or if you're paying from your own pocket, you will gross up, or if there is a payable outstanding, then you adjust from there. The question is, there is an option given to you that you can, that recipient can pay as his advance tax, and you can use that advance tax challan in your reporting. So it is not compulsory that you should only deduct and pay. The recipient can pay his advance tax on this, and you can use that advance tax challan. Now the question is whether advance tax challan should exactly match 10% of that value given to him. Any thoughts on that? How would the officer identify and be satisfied that this is for that very same transaction? Is there a requirement that your advance tax challan, which the recipient is giving you, should exactly match 10% of the value given? There is no such specification mentioned. So what I personally feel is, insofar as you are reporting the transaction, it goes into their net, it goes into the reporting format, and then if it is underpayment also, they will capture it. Now this small case study, so there I need your attention and involvement also. If there is a sportsman, for example, and he has won a medal in some international sports event, there is a company which gifts him a car, okay. Now the question is, the company is gifting him a car, they will click photographs, the chairman of the company will click photographs, it will be in the news media, it will be everywhere in the social media, the company will enjoy promotional advantage out of that. Now whether the company can claim expenditure of that as a revenue expenditure, it's a car given to the sports person. It can claim? Okay. Whether this is a benefit or purchase in the hands of the recipient? Under section 194R, is it a benefit or purchase in the hands of the recipient? No. Why we say so? Sorry? It is not pre-agreed consideration paid for that. That is one thing. Whether the sports person is exercising profession, is it exercise of his profession which has resulted into this? Probably yes, probably no. But as we said that there is no business transaction between the payer and recipient. It is not that he has done something for me and paying that. There is no pre-agreed consideration. Therefore, it will not fit into the requirement of this. So in terms of valuation, what is the value to be assigned is typically all these things. You will purchase airline ticket, you will hand over to your dealers. It will be the purchase price of the cost of the things, which will be treated as a value. If there is something already lying with you, then the fair market value has to be arrived at. This is something I wanted to cover, but in the paucity of time, maybe I will skip that. We covered the case of freebies given to doctors. We saw that freebies given to doctors not allowable in your hands, in the hands of the payer company anymore. But see the double whammy, in the hands of the recipient, it will still be taxable as 28(4). And 194R and 28(4)(y). Can we say there is double taxation on this? Should not happen. Is it possible to say that this results into double taxation? The payer does not get deduction, recipient is still taxed. Possible to say that? Maybe you are already very tired to respond. Yes, I can see a feeble yes also. So this is, there are double taxation of two kinds. One is economic double taxation, other is juridical double taxation. So it's not the same person who is paying tax on the same income twice. It's disallowance in the hands of one person and the taxability in the hands of the other. There is no support to avoid this kind of double taxation. Now take another case. Say there is a foreign trip which the company has announced for its dealers. The company says, you are doing very well, you have met your targets, I want to take you to a player trip. So you tell me whether you are available on so and so dates. In the month of January, the trip is announced. I don't know if this foreign trip is going to excite some of those who are feeling bored. Okay. And the dealers have communicated their availability, etc. in the month of February. And the tickets have been handed over to them in March. The travel takes place in April. Now please tell me at what point of time should I comply with TDS requirement? I have announced in the scheme in the month of January itself. That's a planning phase. Okay, in the dealers have communicated in February, that is done because I announced, they accepted, it is done. February not. March, tickets handed over in March. Travel has happened in April, we cannot defer it to travel time. At the time of release, okay. Tickets are released in March, okay. So tickets have been given in March. And the travel has taken place in April, and if some people have not even traveled, unfortunately they said yes to and finally they could not travel, doesn't matter, it is benefit perquisite given to them. See, I give you benefit, you use it or not irrelevant, you are supposed to pay tax on that. That's the law as it stands. Now take a case where tickets are handed over in April. Tickets, I took an example, tickets are handed over in March. If tickets are handed over in April, travel also happened in April, we are all clear that TDS compliance will happen in April. But as on 31st March, the company announced the scheme, the people have accepted, I am bound to incur a liability, I have created a provision. Whether I am entitled to claim expenditure on provision basis. Can I create a provision as on 31st March? Allowable? Okay. This judgment supports this proposition. Now, if just a quick glance on this, if TDS for some other section, say for example section 184J, it is grossed up, then the grossed up portion is a benefit perquisite for 184R. So it's a chain reaction on that. So if 50,000 was the 5 lakh was the payment under 184J, 10% of that 50,000 I have grossed up. So 50,000 becomes benefit perquisite here. And on this also there is no TDS suffered by the recipient. This also grossed up. So it becomes 55,000. Then I have to make TDS compliance on that. So this chain reaction, there is a numerical example, I think slides will be shared with you. There are certain specific examples given in the circulars, 2 circulars are there. I'll just quickly mention couple of things in that. If there is a discount given, see I give you benefit perquisite cash or kind, that is one thing, but I give you discount. How do I comply TDS on that? It is practically impossible because what I'm doing is I'm selling you at a lesser price. Okay, whether that will be required to be complied with TDS provisions, the circular says I really appreciate there's a difficulty, I remove this difficulty, don't comply with TDS on that, there's no requirement. So that's the benefit really given. I'm skipping some of the things. We'll come to the most important thing in this maybe. We'll just few minutes of more concentration, this is very important. Section has 2 requirements. This section primarily says you have to deduct tax. Deduction means what? You withhold, you retain, you reduce the quantum of outflow. You have to pay 1 lakh, you retain 10,000 of it to be paid to the government, that is deduction. Okay. One, you are making payment in kind, how will deduction happen? I am giving 5,000 t-shirts. I am giving 5,000 t-shirts, 500 t-shirts I retain with me for Government of India, assessing officer good. Not possible, no. So section, they know this difficulty is there, then what do they say? They say that if your payment is in kind or partly in cash, partly in kind, we understand you cannot deduct. So what you do, you ensure that tax that on that is paid. What tax is paid? Tax that is required to be deducted is paid before you release the benefit. Now they knew this because what had happened is earlier in the case of Hindustan Lever and couple of other, Bangalore Karnataka High Court is also there, which appreciated that and which accepted the proposition that if you are making any payment in kind, TDS provisions which require you simply deduction cannot operate. So therefore there will not be any assessee payer will not be treated as assessee in default under section 201. Now, considering that, what the section now says is, if you are making payment in kind, ensure that payment of tax is there. Now, in case of default with TDS, what are the two main consequences, sir? Sorry? Assessee in default and disallowance. Assessee in default happens when one of three situations happen. Assessee in default happens when one of the three situations is there is failure to deduct. Having deducted, there is failure to pay. Or third thing is there is failure to pay. What is this failure to pay? In situations, there are similar other sections like 194S, 194B, which provide for that if you are not able to deduct because it is payment in kind, at least pay somehow. So, for that failure to payment, there is section 201 says you will be treated as assessee in default. Now, what is the language of section 40A clause 1A? Section 40A clause 1A says I will ensure there is disallowance if there is a failure to number one deduct, number two having deducted there is no payment. Section 40 clause A sub clause 1A does not provide for a situation where there is failure to payment. So, this is an important point because 99% of the benefit perquisites are given in kind and there is impossible of deduction. So, therefore, disallowance under 40A 1A will not trigger despite everything being there. So, when you are signing your audit report, you can very well remain silent on non-compliance of 194R. 201 is a separate animal, somebody will have to suffer that consequence separately, but let this not be a trigger point for everything. Now, what you should report in your 194R, shall you simply stay silent? That one option. Or can you have a note disclosed in 190 this to your tax audit report saying that we have disclosed or we have reported all non-compliances with TDS as are resulting into disallowance or as should result into disallowance. So, therefore, you are confining your reporting only to those which result into disallowance, thereby you are protecting yourself also. Some note you are giving. So, you are not taking a responsibility that everything is disclosed, though primarily there is no requirement. But there is a catch here. I want you to appreciate this catch also. This was a case of fish catching. Kanchan Ganga Supreme Court is a case of fish catching. So, there is something fish in this, we must deal with this. What has happened in this case is there was a assessee who was in the business of catching fish. He had taken some equipment and services from a foreign company and in lieu of those services, it was supposed to pay 85% of the sales proceeds of fish that it has got. So, assessee catches fish in the high sea. After catching the fish, he brings to India and then he is supposed to sell the fish and 85% of the proceeds it has to give to the foreign recipient. What it actually did was it gave 85% of the fish itself exported. The question arose whether he is liable to pay TDS on that under section 185. It was a payment in kind. The crucial, why it is crucial, it is a case of payment in kind. Now, the question posed before the court, Supreme Court, was whether this income is accruing or rising receipt taxable in India. The assessee wanted to say it is not accruing in India. The catching of fish activity has taken place in high sea sales, it is outside India. The Supreme Court said, doesn't matter. It has been brought to India. After that, once it comes to India, thereafter only the assessee has acquired control over it. It is an income received in India. So, therefore, Supreme Court said TDS is liable to be deducted on this. But the point of distinction here is they never went into the examination of whether deduction, the word deduction can be a bottleneck in compliance with TDS. So, even though it is a Supreme Court judgment, it is distinguishable on the fact that it is silent on the element of deduction being an impossible thing. So, with that caution, you can still make a choice of whether you want to report 194R as a non-compliance or not. Now, the last thing I would just take couple of minutes and we'll close it. there is an amendment in section 68. There is one very small, very important point, section 68, many of you may be interested in knowing. There has been a long history of section 68. Section 68 says, if any sum of money is found credited in your books of accounts and you are not able to explain the nature and source thereof, then we will charge it to tax as your income. Now, what used to happen was, I will say, I have borrowed money from C. Deepak Chopra ji. Okay. What is my nature of this is borrowing? What is the source? Source is Mr. Deepak Chopra. Department questions, Deepak ji, kahan se aaya paisa? Where did you get this money from? He is not able to explain where he's got the money from. He's given it to me that he's able to explain, but he's not able to explain the source of his funds. So in such cases, the court said that I cannot be finding fault with, he is not able to explain, catch him. Then the law got amended to say that in the case of share capital, if the money sum or found credit in your books of accounts is in the nature of share capital, share application money, then it is not sufficient I explain nature and source in my hands. That person who has given me the money, the shareholder should also explain nature and source. So, and that remained for a while. That was not sufficient to fill the appetite of tax department. They said no, share application se pet nahi bhar raha, abhi we will catch the loan and borrowing also. So what they have done in this budget is, they said in a case where sum so credit is in the nature of loan, borrowing or such amount by whatever name is called, in that case also you have to meet the additional condition that the person who has given me the money, he should explain nature and source. And assessing officer should be satisfied with his explanation. That never happens. Now, memorandum. No, there is a very important thing about memorandum, sir. The memorandum is very useful tool. We use it always when it is in our favor. When the memorandum is not in our favor, what do we say? What we say is, number one, there is no ambiguity in the law. Law is very clear, it says this, memorandum should not be looked into. It's a rule of convenience. It's not a rule of convenience only, it is blessed by Supreme Court also. So, I'll give you one more example. We had a long discussion on section 194R. Section 194R is linked to 28.4. 28.4, when it was introduced in 1964, the memorandum that point of time said, the benefit or perquisite in cash or kind is taxable here. Clearly said, despite that umpteen number of court judgments, they said cash is not taxable. Why? Because memorandum was not referred to. Why? Because department does not refer. Why? I will not say. Assessee pays huge amount to his counsel, they work hard. Department does not pay anything to their counsel, they don't work hard. Okay, so there are cases, memorandum where it works, and the same circular 20D in the Finance Act 28.4 referred to by assessee couple of times when it works in their favor. Despite that, department has never been able to pick that and use in their favor when it was regard. So this memorandum, we will say, what it says, memorandum is very damaging here. Memorandum says that the payer, the person who has lent money should explain nature and sources in his hands. A very damaging phrase here. In the hands of the creditor. So what happens? This in hands word are missing in the section. Section doesn't say that the creditor has to explain nature and sources in hands. So can I exploit that? Can I do something about it? Can I say that when the section says the creditor has to give explanation about nature and source, it is nothing more but a confirmation. What confirmation? Say Deepak Chopra ji has given loan to me. I say who has given, what is this nature of money? I say loan. What is the source? Source is Deepak ji. Department says Deepak ji tell me, yes it is loan, nature confirmed. Source, I am the source. Source confirmed. He is not saying that I have not given. He is not denying himself to be source, no. And he says I am the source. मैंने दिया. So nature explained, source explained. So can I say this is nothing but a confirmation letter requirement? Now take an example. He has got agricultural income. He's given me share capital. Department questions about the transaction. What is the nature? You'll say agricultural income or you'll say share capital. He has to explain the nature of transaction between me. So source also has to explain the transaction between him and me. Source is he. Is that not enough? Now, why I am saying all this thing is, of course, it defeats the very purpose stated in the memorandum. But take an example. Take an example. I have given loan to Deepak ji. Okay? When are you going to return? First you tell me when are you going to return, then we'll talk later. I have given loan to Deepak ji. Government, the department comes and asks me, sir, you have given some money. What is your source? I am not able to explain. I am not able to explain where the money come from. Will there be addition in my hands or not? There will be addition in my hands? Yes. Can I say, go and ask Deepak? Because if the source of Deepak ji is not able to explain, income should be in his hands. Now examine in his hands. Same transaction added in my hands, examine in his hands. He is questioned, where did the money come from? What is the nature? He says loan. Where come from? Sumeet Khurana. Sumeet Khurana already not able to explain his source. Income added in his hands also. That is what the section says. So same transaction, because of my inability to explain, it is added in my income. Is income also, is it fair? So therefore, it is this kind of interpretation which the law is trying to say through the memorandum is going to be very damaging, because it results into taxing the same amount in his hands and my hands for my failure only. Therefore, I say that memorandum is not to be looked into. Law is very clear. The judgment of Supreme Court in the case of Govind Saran, Ganga Saran, that if there is no ambiguity, then memorandum should not be looked into. When there is a very, very important principle, sir. Last thing. When can you say a provision is ambiguous when it is unambiguous? How to find out whether provision is ambiguous or unambiguous? Anybody? That's an academic answer, good answer. The real answer is, if the judge has been able to understand, it is unambiguous. Huh? The judgments, I don't know, if you are not finding, I am finding most of the judgments ambiguous only. So the reality of the situation is, if it is understood by judge, it is unambiguous. And if it is not understood, it is ambiguous. And it has been to some extent, what has happened in some cases, there are two judges, X and Y. X says it is clear, it is this. Y says it is clear, it is this. Both are clear, both are unambiguous, but different. So, and the burning example of this is this judgment of TV Sundaramayangar. High Court says unambiguous, this is the meaning. Supreme Court says unambiguous, this is the meaning. So ambiguity and ambiguity. So it's all how you project to the court and you say this is the outcome. If you interpret in this way, the outcome is irrational. The outcome is harsh. The outcome is hitting my judicial consciousness. You cannot tax the same amount in both the hands for one's failure. Okay, that is how you have to convince, and that is why I say this amendment should not be looked into with the lens of memorandum. And with that, I think I have bored you enough, and I will conclude it here without getting into too much things. Thank you very much. It says to the extent of 10 lakhs. What is exemption is to the extent of 10 lakhs. So what will be taxed is only incremental 1 lakh. That is my understanding of the law.
And the section 68 that way, can it be also challenged on the grounds of impossibility? Because it requires the lender to disclose to the borrower his ITR, his source, his financial statements, his bank statement, which is private confidential data of the lender. Why should
So,
it be shared?
very important point which Deepak ji is raising. It casts huge amount of owner's responsibility on the borrower. What lender say, sir, if you go and ask, sir, can you please lend me some money, sir? Okay, give me your IDR, your balance sheet statement. Is paisa chahiye? You are asking me so many things. I will not give you money itself. So that is what happens in these kind of cases is the way the law has evolved is courts are very clear. You have to establish the identity, the credit worthiness of the lender and the genuineness. So in any closed environment, in any closed transaction between two closed and related parties, ideally there should not be any difficulty in canvassing this. Problem happens when you are having, for example, the way this section has been introduced is it will apply to even public listed company which has issued debentures to public at large. Technically speaking, this is applicable. What the Delhi High Court in the case of divine leasing and finance held is that you cannot have this kind of applicability of this section which puts into the recipient of money in such an onerous condition that he has to reach out to some lakhs of investors, thousands of investors. It is not possible. So they said that you have to make a distinction between private placement and a public placement. So in a large scale transaction, they are taking money from mass scale of people. It may not be a worthwhile, I mean, you cannot be really burdened with that kind of an obligation. But in a closed transaction, definitely the obligation is there.
The obligation also extends with regards to loans taken from banks.
See, theoretically, now, if you see the section as crafted is, if I have taken money from HDFC Bank and said, prove the credit worthiness of HDFC Bank, I don't think so any officer is going to be wise enough to ask me that prove the credit worthiness of HDFC. So, but I don't think that will be really posing any challenge. Do you really feel so?
We've experienced this in the context of share capital.
Yes.
So I have an investor with $1 billion net worth. He's invested in my startup, and yet I'm being asked to justify the creditworthiness of that investor.
So that is happening. I don't think so. That is, see, you may find it to be very unreasonable, but I don't personally think that that's a reason to say that section should not be applied to you. It's a condition which you can comply with. Which.
Why would he share his personal data with me? Why would he give me his balance sheet, his ITR, his bank statement?
See, why would he give you is why has he invested in you? He has invested in you for a reason. Then that investment requires some little more degree of cooperation. Okay, you cannot say that law is impossible for me to comply. You can say that please exercise power under 133(6). Can we really challenge the constitutional validity of this section by saying that it's casting owner's responsibility? This section has been prevailing for good number of years. This, in fact, in the 1922 Act, there was nothing called Section 68. In the 1922 Act, there is nothing called Section 68. Even then, the courts have applied the same very principle. This Section 68 is only casting the judge-made law. So I don't think that it's going to sail through if you try to challenge the validity of the section by saying that it's casting owner's responsibility. See, I'll first answer a connected question to this and come back to you then. See, what is happening today is I don't know if you have, some of you might have received notices. We have received good number of notices on reassessment saying that, the foreign company, this is a reassessment notice in the name of the foreign company that XYZ Inc. you have invested in India so much amount. Please explain me nature and source. You have not filed any return of income. Why this should not be assessed and income is kept in your hands. So there is a judgment of Delhi Tribunal in the case of Finlay Corporation, wherein they have applied the principles of section 68, 69 vis-a-vis section 5 subsection 2 and interplay between that and to examine as to what extent you can exercise these kind of sections in the context of non-residents. So they said for the purpose of taxing a non-resident, first of all, there should be income accruing or arising received in India. This 68, 69 is a deemed kind of an income. First you tell me how are you going to satisfy the condition of accrual arisal in India? You cannot apply 68, 67 first and then say it is 5.2. First you apply the scope of 5.2 and then you say how this thing, and then that context the court has kind of said that it is not possible to tax the non-residents on these things. Now your question is of in the hand to comply with this. The unfortunate situation of the proposition, the law is that it is casting on you the responsibility. As I said, that it is invested by somebody who has good faith in you. It is not a mass scale investment by thousands of people. Okay, somebody who has some confidence of business in your business and some relationship with you, and therefore if he doesn't cooperate, there will be a problem with you. I don't think so you can escape from that. It may be onerous, it may be difficult, but I don't think so there is a escape route for that. I think we can conclude then. Any other questions from any other participant? Too tired? Tea break, maybe rejuvenating you. Okay, thank you all.
Thank you, sir, for the wonderful session on key amendments relevant for tax audit. Hope there are a lot of questions and everyone has understood on amendments for the tax audit. Thank you very much, sir. And I request Vice Chairman of the Bangalore branch of SISA of ICA to present a memento as a token of appreciation. Once again, thank you, sir. And with this, we will have a tea break at for half an hour up to 4:30.